Good morning, everybody. Welcome. Mauricio Salinas, Elite Capital U, Wednesday, September 17. It is Fed Day. Who knew? We got here. Eddie, good morning. Thanks for coming and joining us. Any questions you have, please type it in, or you could always send us an email. The email address is on the chart on top of the screen. SPOOS, S&P 500 futures, getting ready for this Fed Day. And just this, I'm looking at what is called an equivalent chart on the screen. It helps me see what kind of volume we've had with the move that we've been having to the upside. We've had some pretty erratic moves. I mean, the market decided that it wants to go higher, and there's no rhyme or reason. They just want to keep bringing it up. Christopher, good morning. Maria, good morning. So, equivalent charts give us an idea. We look at how tall the bar is. We also look at how wide the bar is. The wider and taller the bar, the more volume was traded. The skinnier and shorter the bar, the less volume was traded. Why do we look at volume? We look for confirmation on a move. If the market is moving higher on lower volume, it indicates a weakness in the market. Angel, good morning. Togo, good morning. Thank you for joining us. If the market is going higher and the volume keeps showing up, that means that there's strength in the move. So remember, price is just an advertising mechanism. It tells you where the auction is at that time, where the market is at that time, and they're looking for either buyers or sellers. If they can find buyers at higher prices, eventually they're going to have to come down again to look where the buyers were again. Those were the levels that we trace. Same situation if the market is going down and the market stops going down, then we need to come up to see where the sellers are again. So it's all a back and forth game. It really is just an auction. Nothing fancy about it. But volume yesterday, even though we did make new highs in the overnight market yesterday, those highs were not tested during the day. So that is a level that is still open for retest because, Ingrid, good morning. Because in the morning hours, in the overnight hours, any move that is created has to be retested. It has to be verified by the regular market hours because of liquidity. Liquidity meaning volume. Okay. So yeah, yesterday we had a negative net day when it comes to volume. The chart that you see on your right, my right, is the bonds futures, the 30-year bond futures, which have been on a tear, also to the upside. So it's very weird to see bonds in the market moving in tandem, even though it's been happening a lot after COVID. But these are usually two markets that do not correlate. Correlate meaning that move in tandem or move together. Usually, the norm is if the S&P 500, if the market is moving higher, the bonds should be moving lower because the bond market is a risk on, risk off market, meaning that it is a safer market when there is volatility or when there is, like they like to say, blood in the water and the sharks are coming. Why do they consider the bonds a safer market, even though it is a bigger market? It is a bigger market than the stock market. And when we have the bonds class, we will learn all about that. But because every single product in the bond market is backed and guaranteed by the credit and good faith of the United States government. So if the government fails to pay its debt, if the government fails to pay the yield that the investors receive when they purchase these products, trust me, the last thing you're going to need to worry is about the stock market. At that point in time, we're going to have to go feral and buy some farmland and get some cows because everything the crap hit the fan. So that's why the bond market is a risk-off market. It is safer, quote unquote, because it is, again, backed by the faith and good credit of the United States government. So I look at the bonds as well because it kind of gives me an idea what the market is feeling. I do feel that this move to the upside was a lot of profit taking. It was a lot of short covering. Short covering meaning there were expectations that the market should be heading lower because we are at all-time highs, and there's usually a nice retrace when we hit all-time highs. And some people came, came early to the party. And again, when you buy a product, and again, you put a stop loss or you have a level that you say, well, you know something, this is my happy-go-lucky place. If if I'm having a drawdown or X amount of money, this is where I'm going to close. So again, what happens when you sell the market to come to the downside? If the move is not happening, what do? You sold the product, you need to buy it back. That buyback makes the stock go higher, makes the product go higher, whatever it is that you're trading, crypto, stocks, bonds, futures, options, whatever you call it, whatever you want to trade. That move to the upside when you're closing those positions, that in turn makes the market go higher because all those stop losses or all those levels where people were wrong are going to be triggered. So that in itself causes a move to the upside. The other thing that confirms that for me is when I look at the market profile, the market time. Let me take this levels up so we have a clear look. Everything, the shape of the profile gives us a very good idea what kind of movement we had. Big Boss, good morning. Thank you for joining us. Catherine, good morning. Going Pack, good morning. Caretaker, good morning. Thank you for joining us. Any questions, please, type them in. Give us a like and follow. We're here every morning, 8:15, doing this every single morning. It gets boring because this is a very lonely business, but it does get boring doing the same thing every single day. But when you find something that works, like they said, if it's not broken, don't fix it. So again, why do I feel that this was a lot of short covering? Basically because the shape of the profile tells me that this is a B-shape profile, so there's a lot of profit taking going on. And when we do this class, you will learn more about this. I know a lot of people trade this like if you were trading levels, value area high, value area low, point of control, and we don't look at it that way. I mean, do we trade that way? Well, depending on the setup that we have, but I basically mostly look at this to have a more holistic view of the market, so I have an idea who was actually trading in the market. If you look at Monday was basically an inside day from Friday, so there was no long-term traders active in the market. Same thing as Friday, even though price did go higher, value kind of stayed in the same place, and now we're having this congestion zone that is kind of telling me that we are, we're kind of stopping. So we're seeing that dome form when it comes to value, which is the characteristics of a market when it's about to break and when it's getting ready to break. Is it going to break? The hell do I know? Nobody knows what the market is going to do. The market doesn't even know what it's going to do. But I do see that when we have these congestions of value areas, means that momentum has dried up, and what we have moving the market making new highs is either short covering, stops being triggered, or FOMO traders. They didn't buy it when it was down here, let's say at a 66.31 because it was a bad idea, but all of a sudden here at a 66.80, that's a good place to buy. Go figure. Trust me, I've been in this business for over 20 years and I've seen some doozies. And there's nothing better than seeing how people trade. It will cracks you up sometimes. So anyway, so Fed day today. What are we expecting today? Usually Fed days are Federal Reserve decision days. They tend to be quiet in the morning. They tend to bring a lot of chop. Jasmine, good morning. Val, good morning. Thank you for joining us. Any questions you have, please type them in. And what I mean by chop is that up down movement that we had yesterday. If we look at let me just show you guys the chart. The chart that you guys will understand. The more that you come here, the more that you will understand the way we trade. The way that I'm going to say the way that everybody should be trading if they don't want to get caught up in the wrong side of the market. Here we go. So this is Monday's price action, and we are looking at the SPX. Let me put the ES. SPX is the index. The ES is the futures market. So let's highlight the overnight session. Again, this lighter area is the overnight session from 6 o'clock until 9:30 in the morning. The dark at Vickers, good morning. How are you? Thank you for joining us. Notification. Val Ramirez, thank you for joining us. Jasmine. The darker shade is the cash market. Cash market being from 9:30 in the morning until 4 in the futures market is around 4:15 when the mark-to-market adjustments begin to take place. So let's look at this from yesterday. So let's analyze right here what happened. A lot of people trade the overnight session. I do not trade it because there is no liquidity. A lot of the times it's like watching paint dry, but you can trade it. So here we go. This was yesterday's price action. Market open, tested the risk marker level that we have marked for the previous days. Market came down, and it's basically, this movement after its form looks very easy to trade. Gonzalo, good morning. Thank you for joining us. It looks very easy to trade, but the situation is that everybody's a superhero after the market, after the chart is formed. Oh my God, look how, you get in here, you get out there, here you go, candlesticks, because I know you guys love those. I trade off bars, I don't trade off candlesticks, but we're here for you guys to learn, so I will show you what you guys like to see. Michi, good morning. Si alguien no habla inglés, este video, después que se coloca en YouTube, hay subtítulos en español para ver la traducción, y el live de mañana va a ser en español también por la mañana. Just letting everybody that may not speak English, if anybody here doesn't speak English, that the lives are recorded and they're posted on YouTube later on, and they do have subtitles, and you could actually change the subtitles to the language that you speak. So there's that. Anyway, after this is formed, it's very easy to say, well, I would have bought here and I would have gotten out here. Well, yeah, that's very easy to say. But when the market is actually trading, how do you know? Oh, well, I look at the candlestick formation, I look at this, I look at that, and at the end of the day, it's all about context. Context, liquidity, and volume, and also the time that you're trading, okay? So when I said yesterday that it was it was a choppy market, it may not look like a choppy market, but when this is being formed, these candles, there is a lot of two-way action going on, okay? There is, when you see a lot of wicks on your candles, a lot of tails and wicks, that is a market that is very irrational, because there's highs being made, there's lows being made in that period of time when we're looking at a 30-minute chart. And a lot of people get caught up in the wrong direction. It is not a trending market, a trending market that is just basically making new highs, new lows, new highs, new lows, or vice versa, going down. So usually the days before the Fed, we're going to see this kind of price action. We're going to see a lot of choppiness, a lot of indecision, because the market is waiting. So if we look at the price action since Friday, this is what we have. Basically, market has done new highs, but that was either done in the morning hours or basically just a high that was created by by stop losses being triggered. I mean, that's basically the way I read it. So here we go. There has been a price action since last Thursday. Thursday we came into this pretty little box that we have here. Call it whatever you want. Call it a range. Call it a non-trending market. Call it sideways action. Whatever you want to call it, is still the same thing. So when you learn to recognize these type of movements in the higher time frames, if you're a scalper, it's going to help you a lot. Why is it going to help you a lot? Because if we're doing this on a 30-minute, and you go look at this, a lot of people trade 1-minute charts. Well, here you go. There's going to be your 1 minute. Let's look at the last 5 days, and voila. You see all the price movement inside the box. So if you're a scalper, this is going to help you to know where your ranges go. So it's not just going to be about trading from the middle of the box or the middle of the range. You should just be trading from the top to the bottom to the top. Context is everything in the market. It has nothing to do with candle formations. I mean, you could learn all the candle formations, you could learn the pattern, all the patterns, anything that you want. But if you don't have context in the market, especially taking out, looking at a higher time frame, unboxing out the price action to see where you are, then you're going to have an issue. Luisa, good morning. Thank you for joining us. Luisa, buenos días. ¿Cómo estás? So there's that. What am I expecting today for Fed Day? Exactly the same price action. Some chop. Maybe we go test some highs. Maybe we go test some lows. But the real price movement is going to come around 2 o'clock when the decision is announced, and that's going to create some movement. But then also the press conference. When the press conference happens, then you're really going to see the rest of the movement happening for the day. We will be here at 1:30 looking at the Fed decision. We're going to have like a mini crash course on what the Federal Reserve is. If you guys want to come and join us, we'll be here live. So there's that. All right, so that is really what I am expecting for today. We do have some levels that we trace already for today. And let me just remove this. Let me highlight the overnight market. Overnight market basically is your sessions from Europe. We're talking what you want to highlight. Okay, you want to do that? We'll do it another way. Your overnight sessions start around 6 o'clock in the afternoon, our time here. That is when Sydney opens, Sydney, Australia. Then it moves to the Asia section around 7:30, 8 o'clock. By 9 o'clock, all those markets are open already. Then we have some sessions in Africa as well. 2 o'clock in the morning, the futures market in Germany open. That is your DAX. 3 o'clock in the morning, that market opens for trading. And then also the futures market starts moving more in the FTSE, which is the the market in England, that market. Then by 4 o'clock in the morning, everything is moving in tandem. Okay, so we follow this not so much because of what they do that's going to affect us. I know some people say, well, if Europe is down, market's going to be up. If market is up, Europe is down. You need to understand that a lot of these ideas that are being taught out there, they're outdated, meaning that this stuff may have happened in the past when electronic trading wasn't around that much, or when it was actually starting back in the 70s. I mean, you need to realize that electronic trading didn't really start taking place until the 90s. A lot of this stuff was literally done by hand, and people don't believe it, but it was. 50s, 60s, there were no computers, there were no stuff doing this. It was all done by hand. You had to call your broker on the rotary phone, just sit there and just dial and, wait for him to pick up the phone and, wait for them to place the order, and you're looking at a newspaper. So, we don't know how good you have it today, when it comes to trading. So, Europe, Asia, and now this the English session and the German session are going to coincide when we open at 9:30. There's going to be a lot of orders that need to be filled, and the market takes care of all business first. So a lot of the stuff that happens within the first half hour to hour of the market is either all positions being closed or being adjusted, stop losses being triggered, or profit taken. So always remember that this is just like any other business. I mean, if you have let's say a supermarket, for argument's sake, when merchandise comes in, or when you want to move merchandise, you move the old stuff first. You take care of your old stuff first, then you move into your new stuff. Same thing with the market. The traders, institutions, whatever you want to call them, they do take care of all business first, and then it's to new business. Okay, so we're going to put some of the levels that we had from before. And as you can see here, we have this overnight high that was done on the 16th. That hasn't been tested. So what I usually do, or what we do, is we carry these levels forward because the market does remember. The market does remember these levels. high price, it is going to be tested again. When? We don't know, but it has to be there because these are like magnets to the market. You have your high price from yesterday, your regular, cash hours high from yesterday. It is forwarded to today. Then you have, let's see, you have here your settlement price. That was the settle price from Tuesday, from Monday to Tuesday. That level is no longer valid because it was already breached. So what we're going to do is we're going to transfer it here for the settle for this morning, and we will do it in a little bit. What else do we have? This was the overnight low from Tuesday. Again, you see how these levels come into play, and there's a lot of price action around it. If I extend this to the right, apparently this level still has some kind of a liquidity on it. There's still important, so we'll just keep it there for today, see what happens. And then we have your overnight low from a long time ago, because this is another level, and it's been traded through so many times that it's not even valid anymore. So we're just gonna, what we're gonna do is we're going to adjust this level so we can have our overnight high, which should be around 66.74.50, and your overnight low, which should be this week right here, 4:30 in the morning. This is something that happened in England, and we're gonna look at the news to see what caused this spike to the downside. All right. So again, we're going to edit this one, and that's going to be the low for the 16 to the 17, and the low is low 66.53.75. 0.75. Every single morning we do the same thing because that's what we do. So there's your overnight low. And this one, I am just going to edit it as well. I mean, it's pretty close. It's pretty close to all this chop that happened here. It's pretty close to the overnight low from Monday, from Tuesday. So it's a general area. You know something, guys. Don't try to be so exact when it comes to your trading, because exactness will kill you. I mean, this is a business where there's a lot of guessing going on. And yeah, that's the word guessing. I'm not guessing. I have my technical analysis, and I have my Fibonacci, and I have my candlestick pattern book next to me. Look, at the end of the day, you're just guessing, okay? You could have the best analysis in the world. You could have the best tools in the world, the best computer, but once you hit the order button, you're at the mercy of the market. So yeah, there's a 50-50 shot you're going to be right. And I tell this, I think I've said this plenty times before, professionals, people that actually do this for a living, for corporations that, believe me, pale in comparison to our size, they are wrong. I mean, they are wrong pretty often. I mean, their percentage of being right is about 55 to 60%. So yeah, at the end of the day, it's all a guessing game. 66.73. So the question is going to be, well, then how do I make money? You need to learn to trade the way that these people trade. We look at probabilities. Everything is probabilities in the market. What are the odds of A happening besides B? What are the odds of the market actually coming higher to retest this overnight high, as opposed to dropping and testing all this crap that is going on down here, or actually coming down to test the low of the overnight? That's where this type of chart comes in. This is going to help you with probabilities once you learn how to read the shapes of the profiles. That's going to help you a lot with probabilities. Then you learn to read momentum, which is it is the only thing that moves before the actual auction, before the price does. And then you just need to learn to read volume and order flow. Once you have those three things, then you should be pretty good. And we're going to be looking at options a little bit in about 15 minutes, to give you guys an idea what options are. If you guys don't know, if you guys do know, maybe stick around, maybe you learn something new. And so we pretty much have let's do our settle. What is the settle? The settle for last night for the December, 66.67.50. So we're going to move this level, and I will explain to you why we do all this. One thing that you guys need to understand is that you do not make money in the market when you're pressing the button and putting orders. You actually make money in the market when you do your homework, when you do your game planning, whatever you want to call it, when you study, when you keep a journal, when you take notes, when you actually have a game plan and a thesis covering what may happen if the market goes up. What do you want to see for you to take trades to the upside? If the market comes down, what do you want to see if the market comes down? Or if we have a choppy market, what are the edges of those levels that you're going to be trading off? If you have at least that done the night before, if you have some kind of a plan that you could actually write it down, and I say write it down because when you write things down, neural pathways in your brain actually are created and it helps you recall information easier. If you have this game plan done, if you have this trading plan ready in the morning, you're not at the mercy of the market. I mean, if the market does whatever, what you want to see the market do for you to trade the trades, then you trade. If the market is being irrational, because believe me, the market is irrational, then you don't trade. You need to understand that this becomes a job. If you're going to be an intraday trader, if you're going to be a day trader, a scalper, if you think that you're going to sit here and you're going to make thousands and thousands of dollars just by doing nothing, you are in for a rude awakening. This is a very taxing business. It is a stressful business. It is a business that requires a lot of time, a lot of effort, especially if you're beginning. Once you have an idea of how the market works, once you have a system that works, it gets pretty monotonous. You're doing the same thing every single day over and over again, and that's why you see me here. I've been here doing these lives for you guys for a couple of weeks already, and I don't change anything because this is what works. I mean, this is literally what works. This is what we taught the traders that used to work at the company that got bought out. 15 people making money doing exactly the same thing that I'm teaching you guys how to do every morning. So take that with a grain of salt, but if you learn this stuff, you learn to be responsible when it comes to logging your trades, journaling your trades, journaling everything about this business, how it makes you feel. You will make money, but it's gonna take it's not gonna be overnight. So here we go. So what did I just do? Again, overnight high, overnight low. I don't care about the London high. I don't care about the Asia high. I don't care about the this high, this high. That's gonna be it's like they say, not too much, not too much. Look, high, low, settle from yesterday. That's it. What else do I have? High, low from yesterday. That's your RTH low, your regular trading hours low. That's what it stands for. Regular trading hours high. That's it. That is really all I need to see because those are going to be the levels where the most liquidity is going to be. Plain and simple. Asia high, London high, this high, that high. What? There is no liquidity, especially in the ES. Because those markets trade their products. If you're going to look at the Japanese market, if you're trading yen, if you're trading those, if you're trading yen futures or that index futures, then yes, you do need those highs and those lows because that's going to be the liquidity that is set for those markets. When it comes to the ES, the S&P futures market, or even the NQ, because this, you should be doing this with the NQ if you're trading the NQ, then that is something that you need to trade. You trace the levels for the market that you are trading. Plain and simple. If I'm trading the ES, that's my bread and butter. I mean, I trade ES, I trade oil, I trade the 30-year bond, and I trade wheat and I trade gold. Maybe next week we'll do some pre-markets for those, for those products, and so you guys see how I prepare. Why is it different? Because remember that futures markets do not all operate in the same schedule. If you're talking about index futures, the NQ, the ES, the Russell, and the Dow Jones, yes, those do have the same hours of operation. But when you're looking at oil, that has a completely different schedule to work with. That market opens at 9 o'clock in the morning and it closes at 2. If you don't know that, you might be in a trade at 2 o'clock in the afternoon thinking that you're going to be open until 4, and then all of a sudden the market just dies because you don't know what time it trades. You need to know your risk. Oil is $1,000, per point move. That means that you can make $1 or lose $1,000. If it moves $1 up, you make $1,000. If it moves $1 down against you, you lose $1,000. Big risk. So these are things that you need to learn and you need to understand. So why the ES? That is my bread and butter. If you tell me trade one product only, give me the ES. the SPY, same product. The SPY, the ES, they're all the same product. The SPX is the index, okay? So what do I have here? I have my framework for today. Basically, this is the box that I'm looking to trade today, right here. Voila. For here. And if you look at this blue, purple, whatever color that is, I did tell you guys that I am a little colorblind. That looks blue to me. And you look at this red dotted line at the bottom, this is the range of risk that the market has today based on the options of the XPX. So we have a whole lot of risk for today. We have a lot of movement that the market is expecting or is putting out there as risk for today. So we do have our levels based on highs, lows, settles, and closes. But remember, these levels here that you see here, this one up here, and I will circle it. And then next week, I'm gonna have my pen back, so I'll be drawing on the screen. You're gonna love my drawings. It's gonna be easier to teach. This level and this level, this is not based on technical analysis. This is not based on any type of study. This is not based on anything other than the options market liquidity. These levels are marked by the risk that actual traders, institutions have in the market. This is where the risk lies for today. So as long as the market stays within this box here, those people are happy, because remember, they sell a ton of options to make money, so they can have money to invest to buy other products. That's the way that it works. I gave that explanation a few times already in the back. If you want to go back to YouTube and look at those, those lives, you will see the explanation on how that actually works. So this is the box for today. We're gonna, whoops, not the box, that is a circle. So this is what we have planned for today, right here. That includes the overnight levels, that includes the risk market for today, that includes the settle, that includes pretty much everything you need to do. What are these levels for? Risk mitigation. Risk mitigation. What do I mean about risk mitigation? It gives me an idea if I am wrong, how much am I going to lose? So right now, the way that I look at it, I am in the middle of a crap load of chop. It's just from here, from last Friday. It's just moving up and down. So we're here. Oh my God, I think I see a head and shoulders. Look at that. Yes, I do know all your patterns. This one is a little discombobulated head and shoulders, but hey, look at that, a little shoulder ahead. And this one has two shoulders. It's a mutant. Anyway, strong zone of resistance down here. There's a lot of orders, sitting here for whatever reason the market refuses to go down. So let's say, for example, I decide that I want to take a trade to the upside. I know you're going to talk about your stop losses and all that good stuff, but stop losses, as we all know, they're psychological, and when things are going against you and you feel that the market is going to turn around at any time, you just move your stop loss, because what the hell, what's another 10 points to the downside. This gives you what you guys are looking for, called risk reward. So not all positions have the same risk reward based on liquidity, based on the levels in the market, because that's what the liquidity is. So if I decide to take a trade to the upside from here, let's say from this area right here, what am I looking for? If I am wrong, I'm going to be wrong if we breach the 66-61 level and I have a whole lot of movement to the downside. It's going to happen fast. But if I'm risking 62, about 2 points, give or take, to make, that's 62 to 60, that's 5 points. Risk 2 to make 5. That's okay. Do I want to trade here? Hell no. Why? Because look at all this. This is, the market, if for whatever reason it decides to breach, there is a good probability that it will move very fast to test that level again. So if I'm having an inside day, a choppy day, I would rather wait for the market to breach this level I still have the 2 points risk, but instead of making 5, maybe I'm going to shoot and go for 7.5, 8 points. That makes more sense. How do I decide which one am I going to go? It has everything to do with the way that we open. Are we going to open inside the market, inside yesterday's range, or are we going to open outside of it? It's really that simple. That's the first thing you got to do. The second thing you got to do is, what kind of day are we having? Well, it's a Fed day. We're expecting chop. So don't expect any sudden moves, in the market. If you have those expectations clear, nothing is going to surprise you. And then you have those levels to move to and from. The market is always moving from level to level to level to level to level and to level to level if it keeps going higher. And there's your risk marker for that. Okay. Same thing to the downside. All right. Any questions about that? Anybody? We're good? Good to go. All right. So we have about 10 minutes. Let's go look at what happened. Let's go look at the volume for today. Let's go look at the volume. Volume. Where are you for the ES? Remember that we're in the middle of a rollover, meaning that there's contract for December is no longer being traded. I mean, it is being traded. You could still place orders in it, but it's not liquid anymore. As you can see, it only has 65,000 contracts right here. The one that is active is the December expiration, UZ. That has about 144,000 contracts. I mean, that rollover should be done by Friday, and then we're going to have a better read of what the volume is. It's kind of hard to to make out what it is. Let's see what the volume on the bonds was. Like I said, I do trade the bonds, so I do like to see that volume again, as well. 98,000 contracts. Who knew? That is a ton of movement for the bond market. So clearly they're expecting something. That's basically what it is. So we looked at that. Let's see what news we have coming up for today. We do besides the Fed, we do have a calendar that is packed with chocolate covered grenades, if you want to call them, that are little firecrackers for the market. So all this crap already happened this morning. This is in Britain. Here we go. This is the European Union. Oh, look at that. At 3:30 a.m. Lagarde was speaking today, so that might have been the reason for the spike to the downside that we saw in the morning. Maybe the market didn't like what she said. Who is Christine Lagarde? She is the Jerome Powell of the European Union. So she is the president of that European bank, that if you want to call it the Federal Reserve of Europe, that is not the correct name, but just for comparison's sake. So when Lagarde speaks, the rest of the world also listens, because remember, the European Union, it is a big financial market. Okay, so we had so I'm guessing something she said just kind of spooked the market, and they were not happy about it. So we have housing in Europe, blah, 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 blah. Then we have something in Germany, blah, 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 blah. But here we go, US. 30-year mortgage applications, the rates, 7 o'clock in the morning, they're supposed to come out. They're expected, they're actual, there was no forecast. They're just telling you what it is, and they are lower by 10 basis points. We have mortgage applications went up, of course, because people are expecting the rates to go down. MBA purchase index, we don't care about this stuff. Building permits actually slow down. Building permits kind of measures the new permits that have been applied for new construction. This is not old houses, this is brand new construction. U.S. economy, backbone is the real estate market, especially the residential real estate market. If you see building permits kind of slowing down, that gives an idea that maybe people are not buying that many new houses, because builders are not going to build houses for them to just sit in the market. All right. Housing starts, again, down from before. Let's see, what are we going to have when the market opens? Crude inventory, that's something I'm going to be looking at. I'm going to be looking at that. Crushing crude inventories, that's something I'm going to be looking at. What else do we have? Blah, blah, blah. Fed speak. Baba, some guy from Germany from the Fed is going to speak, whatever. The people listen to what he says. That's mostly for the European market at 1 o'clock in the afternoon. Does not concern us. But here we go, 1400 hours, 2 o'clock. Interest rate projection, interest rate projection for the second year, interest rate projection for the third year, rate projection current, rate projection longer, and FOMC right here. That's the one that we're going to be looking at 2 o'clock when the indecision comes out. Now, everybody's waiting for the decision, but the market has already said that, hey, there is a 94% probability that the Fed is going to lower the interest rate by 25 basis points. The market has already it's already priced in. It already is there. They already know. They look at the movement in the bond market. That gives them an idea. They look at the news conferences that Jerome Powell has had before, and as he has said it, he's a very numbers-driven person, data-driven. Okay, so let's see what he says today. It will throw a huge monkey wrench in the machinery if he decides to leave just rates untouched, because then this is going to be, I'm telling you, that's just going to drop the market. So he is playing a very tight game of chicken now with the market. If he doesn't lower the interest rate, the market's going to drop because apparently inflation is still going to be higher. Unemployment is kind of creeping up again. But if he does lower the interest rates, that's going to create, a buying frenzy. People are going to start refinancing. People are going to start buying stuff that they can't afford because they're going to be borrowing money from credit cards at lower interest rates. Lines of credit on houses, loans. That in itself is going to drive inflation higher because we're going to have a lot of people chasing the limited amount of goods that we have because of the trade war. There's a lot of stuff that's not coming in anymore, and the stuff that's already on the shelves, a lot of people cannot afford it. So he's playing a very he's playing an interesting juggling act. Also, what happens today is going to have a lot of repercussions in the world economy because we, as a country, are broke. I mean, and I hate to say it, but it is the truth. I mean, we're talking about, $13 trillion in debt. That's a T with a trillion with a T. In most of that debt is servicing the debt that other countries have bought from us, and we're going to go over that this afternoon at 1:30, 1:45 we'll connect. I'll give you like a mini Fed and bonds crash course, so you know exactly why the government in this country is so much in debt and we just can't afford it anymore. All right, so that's what we have. So these are your levels for today. That's what we have. The most important levels are going to be your risk markers. If you want to write it down, 67.23 will be your risk marker to the upside, and your risk marker to the downside will be 66.2198. All right, let's go look at the SPX. SPX, why do we look at the SPX? Because the SPX is the index. So you have some kind of a hierarchy in the market. Well, you do have a hierarchy. You have your index, that is the main product, that is the product that tracks, let's say for example, the S&P 500. It is tracking the movement of the biggest 500 companies in this market, what they call the blue chips, okay? We're talking about companies that are worth trillions of dollars, billions of dollars. So that is the index. All it does is track the movement. Can you buy an index product? You cannot buy an index. Look, I'm clicking here to buy. You see how buy and sell does not come up. The only way to trade an index is to trade it via its options contract. All right, and we're going to get into the options in a few minutes when I explain to you what an option is. The second product that comes into the hierarchy is going to be your futures product. Again, SPX is the index for the S&P 500. The ES/ES is going to be the futures contract for the S&P 500, okay? Then the third symbol, and believe me, there's a ton of variations when it comes to the ETFs, which are called exchange traded funds. These are products that are created by private companies that follow and mimic the movement of the index. So I don't know if you can see this, but all these charts, if we put them on a daily chart, 1 year, let's do year to date. How about just this here? Yes, this year to date. Oh, there you are. You already are there. Let's put this in candlesticks so you guys can see how it looks with candles. And this one is already at year to date as well. Yes, it is. And we'll do candles for this one as well because I'm nice like that. Doesn't this look like exactly the same product? It really does, because it really is. It is basically the movement. The movement of these products are exactly the same. So whether you're going to trade the index, whether you're going to trade the futures contract, or whether you're going to trade the ETF, the product that you should always be keeping an eye on is the SPX, the index, because that is the one that is going to dictate how this stuff reacts. Okay. That being said, if you're doing any type of scalping, let's say you're trading, you're scalping with the NQ, you're scalping with the Dow Jones, and please don't scalp the Dow Jones. That's a dog. It's only 30 companies. The risk, the risk for me is just not there. 30 companies doesn't tell me anything. 500 companies actually do. And one thing that I say, as the SPX does, so does the rest of the market. So whether you're scalping any type of stock, whether you're scalping Apple, whether you're scalping Tesla, whether you're scalping Nvidia, you should always have your futures contract on the screen. It doesn't matter if you never trade a futures contract because of the margin requirements, because you don't like it, because it moves too fast, it moves too slow. Maybe you like stocks. I hate stocks. I say it all the time. I do not trade stocks. The closest thing to a stock that I get is the ETF. Why? Because if you think this market is manipulated, go look at the stock market. That thing is a doozy. The futures market is universal. It's the same price here as it is in Tokyo, as it is in Germany. This contract right now, the futures contract 66, 67, 25, that's universal all over the world, plain and simple. There's no manipulating the futures contract. But there is a lot of manipulation that can be done with stocks. Let's say for whatever reason, God forbid Elon Musk, something happens to him. What do you think is going to happen to Tesla? It's going to drop like a rock. Same thing with Apple. Apple is kind of in a hotspot right now. But with this iPhone 17 release, people don't want it. People are tired of the same crap, with different names and more price. So does that happen in the futures market? No, because the futures market is mainly used as a hedging mechanism by big institutions, specifically the S&P 500. But if you're trading Apple, let me give you my rhyme or reason for telling you that. So if you look at Apple right now, you see a huge drop in Apple exactly because of the product announcement. But let's look at a 30-minute chart, and let's take the overnight market off, and let's look at Apple in the same 30 minutes. Okay. Here's Apple. This is Friday. Movement to the upside, movement to the upside. Chop, we have chop. We have another gap. Chop, we still have chop. All-time high or new high. Well, look at that. The futures market did exactly the same thing. Fade at the close, fade at the close. Okay, so because the S&P 500 is right now so consolidated in the 7 biggest tech companies, and it's always been like a GPS for the rest of the market. Even if you're trading the NQ, you should be looking at the S&P 500, because as the SPX, as the S&P 500 does, so is going to go the rest of the market. So if you're trading any type of stock, you should have a futures contract in your screen that you know how it moves, because that is going to be the preamble of how your stock is going to do. Because believe me, stocks, they'll move in tandem with the index. There's going to be some stocks that are going to be outliers doing whatever the hell they want to do, but eventually everything is going to start moving in the same direction. So why do they call them futures contracts? Because that's where the hedging happens, and those will start moving before the actual stock does, or almost at the same time. Okay, so keep that in mind. We will have intraday classes as well, and scalping classes. We do all that stuff. So why do we look at the SPX? Again, biggest product, and the SPX does give us risk markers for the week. Just the same way that we have risk markers for the day that are derived from the SPX, we do have risk markers for the week. Again, these levels are based on the liquidity in the options market, the trades that have been placed, and the amount of volume that has been traded in this specifically these options. So closing price for the SPX last week, 65.84.19. All-time high was done on Friday. Another all-time high on the 15th. Another all-time high yesterday. As you can see, we are moving towards the upper risk marker for the week, which happens to be here. That's from the close. That will be the top of the risk marker. As long as the market stays within these lines, everybody's happy-go-lucky. What am I expecting for today? Well, we do have an all-time high that we would like to retest. But as we can see, the futures market is actually coming down. So why do I have these levels? Why are they important to me? Because if I move down to a 30-minute chart, here we go. Same thing. Again, we're stuck in the trading range. It wouldn't surprise me if we come down to retest this all-time high from Friday again, and we come to retest the settle and the close from last week before we actually move higher. Okay, that is one scenario. The other scenario that we're going to come and take out this all-time high and then just move to the upside. That is more probably what's going to happen. And here's the risk marker for the SPX for today, 66.57.45. So if we move to the downside, we're going to be right here at this at the pivot for the week. That is also where the risk marker is for the for today. Again, everything moves in levels. Everything moves from one place to the other. But the product that we want to watch is the SPX when it comes to risk, because that is where institutions are buying and selling options contracts. All right. Let's talk about options real quick before we finish. When you get into this business, does anybody have any questions? I mean, I see a lot of people that are joining us. Thank you for being here. Anybody has questions, please, write them out or send me an email. I'll be more than happy to answer them. Okay, when people get into this business, especially nowadays, they start with cryptocurrencies. They start with forex, forex market, currencies, pairs. They start with futures, specifically the NQ, chopping around on a 1 minute chart. I mean, look, is there anything wrong with that? It all has to do with the level of risk that you want to take in the market. It really comes to that. What risk level are you happy trading? For example, the NQ, if you look at this thing in a 1 minute chart, I mean, I don't know, I am not comfortable trading this type of price action. It's just not me. But these products, when it comes to stocks, it will be stocks, crypto, futures, whatever it may be, they do come with a degree of risk because of the amount of money that you have to put up to be able to trade. So instead, what do? There's something called the options market. Options market, and we're going to go look at the SPY, which is the ETF for the S&P 500. Yes, we do have a position there that is currently underwater. This is one for it's a 60-day. We're kind of early to the party. We're expecting the drop. So once this starts working, we will add to it. That was just a feeder. Options. What is an options contract? For example, if an options contract, it is a way of you participating in the market without actually having to buy the stock or actually buy the product. So when we look at the SPY, we're going to be trading what we call the S&P 500. That is basically what the product that you're trading. When you buy the ES, when you trade the ES, you're trading the futures of the S&P 500. We also have futures contracts for companies like, I don't know, let's see, Tesla. There you go. There's your options chain for Tesla. This is called an options chain. These dates on the side are called the expiration dates of the contracts, when they are going to expire. So if we look at this 19 September 25, the little number in the parentheses is the days that it has to expiration. And this 100 means that you are being backed or controlling 100 shares of the stock. You do not own the shares. You own the option to either purchase or sell the stock at a future date. So let's say, for example, this right here, the strike price, is basically the price of the stock that you feel this market is going to be at September 19th. So let's say, for example, if I buy the, I don't know, the 415 strike, I am thinking maybe that Tesla is going to be at that price by September 19th, right? If I do the 382, I'm thinking that maybe Tesla is going to be at that price, and then of course I'm not going to be buying to the upside, I'm going to be short selling the market. So how does the option chains work? Calls, these are the options that you will be buying if you feel the market is going to be going higher. Your puts on the left side, right side, my other left, are the options contracts that you would buy if you have a negative view for the market, if you feel the market is going down, okay? You are controlling 100 shares, you don't own them. So let's say, for example, let's say you bought the 415 and the market on Friday is at 450. That means that somebody has to give you stock worth $412. That's what the strike price is. But then in turn, you need to have the money to pay for the stock. So guess what? If you bought this at 415, 412, whatever it might be, and it's moving your way, make your percentage and sell it again. You never own the stock until expiration. So this is an easier way and a less expensive way of trading the market. There are there's a lot of moving parts when it comes to an option. If you see here, you see delta, gamma, theta, vega. Those are called the Greeks. Those are basically the mathematical calculations that determine the price, what they call the premium or the price of the option. If I were to click on this 1375 at the 415, so it's telling me that I'm buying one contract of Tesla with an expiration date of 19 September 2025, the strike price, meaning that the price that they have to give me stock at if the contract expires, with value, again, in the money, out of the money, those are things that will also have to be talked about. I'm going to be paying $13.75. That means that this is costing me $1,375, and I will be controlling, in theory, 100 shares of stock. How much would it cost me to buy 100 shares of Tesla? Well, let's say buy. This is the stock. Let's say we're going to do 100 shares of Tesla. How much is this going to cost me? Well, this will cost me $20,000. I mean, wait a minute, $41,000. That is a lot of money. You see why is this better to trade with options? Because you have the buying power, you have the leverage to take advantage of the price movement of the stock, but with less capital risk. Let's say the same thing with Apple. If I wanted to buy a contract of Apple, that, remember, I am controlling 100 shares, this will be about $280. If I wanted to buy 100 shares of Apple, that's going to cost me how much? Let's look at it. Buy 100 shares. Come on, 100 shares. That is going to cost me $23,000. So which one are you more comfortable risking? $23,000 or $280? Okay, you're still going to get the price movement, but again, all this, the value of your premium is going to be determined by your Greeks. There's also in the money, at the money, out of the money. We have to deal with gamma, theta, vega, all this stuff. And the most important thing that you need to deal with is implied volatility. One thing that I tell all new traders, everybody that is coming into this business, is I don't care if you ever trade an options contract in your life. Let's say you're a scalper and you want to trade, what the hell do I mean? NQ. Okay, good. You need to know options. You want to trade Apple. You need to know options. You want to trade Bitcoin. You need to know options. Because why? Because all of these products have options contracts. All of these products, the majority of the trades when it comes to the institutional side of the business is done with options contracts, because there is a limited amount of stock that is available out there to purchase. So these are synthetic products that help you trade on these products. They give you a large amount of leverage, but you also need to be careful. The other nice thing about options is that you only risk what you pay for the option. So let's say 280. Let's go back to this 280. Let's say the stock, you say you want it to go higher because that's what you bought the call. Let's say the stock drops to zero because, I don't know, Tim Cook, just went to Vegas and decided to gamble the whole freaking company for whatever reason, and he lost it. The most that you're going to lose is what you pay for the option, $280. That's it. There is no stop loss when it comes to options markets. There is no stop loss when it comes to options contracts, because the most that you can lose is the 280. So the nice thing about the options is that if 280 is too much of risk for you, then maybe you should be trading something less expensive. Maybe you shouldn't be trading Apple. Maybe you should be trading a product that the options is not as high. So maybe you trade something like the SPY. Even though the SPY, it is price-wise more than Apple, when you look at the options market, when you see this market open, you're going to see that the prices on these options is going to tighten. Well, maybe not today because today is Fed, then we have a 20% implied volatility risk. So the market is expecting some movement. That is the nice thing about the options market. Like I said, just because you don't trade, you might not trade it, but it's going to tell you everything that you need to know about the market. Implied volatility, that is the implied movement of a product. Not what happened in the past, what happens in the future, is going to tell you about risk markers. It's going to tell you about volume that is being traded in these options, because there is volume and open interest. If you learn to read volume the way that institutions do, and right now Thinkorswim might hate you because the volume column is not working. Schwab, Chucky, I hate you. You killed it. So volume and open interest, they do give us an idea of the way that institutions are positioning themselves, because guess what? Institutions trade options. So when you learn to read the options market the correct way, you will have, what the heck is my open interest? Where are you? There we go. There you are. Don't hide. Look, right there. You will have an idea of what kind of positioning traders are doing. We also have in this options market, just like everything else, we do have time and sales. Right now it's not open because for whatever reason, Thinkorswim doesn't want to work. Option statistics. This is something that we use during the day when we are day trading. Specifically when we are having, for example, either a trend day. It gives us an idea if a product is going up on weakness. Not so much because of the volume of that we're seeing on the stock or the futures, but remember, if 95% close to that number is being the trade is being done in options, then I should know if institutions are trading the options or if it's just retail traders. So again, if you're a beginner or even if you're seasoned in this business, you need to learn about your options market, because it's just going to give you a heads up against your competition. Because remember, at the end of the day, we are competing against the best of the best, the cream of the cream. And if we use the tools that they use, like the options, statistics, time and sales, open interest, volume, implied volatility, you are going to be ahead of the rest of the people that have no clue what this is and are just looking at a chart, tracing highs and lows in candlesticks and wicks, and have no clue how the rest of the market works. At the institutions actually look at the market. Institutions, they don't care. I was going to say something, but I'm not going to say it. They don't care about 1 minute charts. Institutions don't care about your high, your low, or your order blocks, or your fair value gaps, all that crap. There is no trader in an institution sitting down looking at this chart tracing that crap. So just take that with a grain of salt. All right, it's about 9:20. Thank you for joining us. Again, I will be here at 1:30 today. We will be breaking down, we're going to have a crash course on the Federal Reserve. If you don't know how it works or what it is, you're going to have a pretty basic understanding when we finish. We will be looking at the rate decision, which we kind of know already what it is. The market already priced it in. But then we'll see the reaction to the news conference. That is the thing that we need to watch, is what is Powell going to say and how is the market going to take it. But what we are going to be looking at the most is how that is going to be traded against the levels that we have marked on the screen. And that's, it's a nice thing to see when your levels get hit and you have an idea of when to get in and when to get out. All right. Again, thank you for joining me. Any questions you have, please send it send it to, here, you send it to the email. You can message me directly. I do answer my messages and I am available for you guys. Thank you for joining me and break a leg. Bye-bye.